I'm Taylor Riggs in San Francisco, in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, a record low. Uber stock sinks Tuesday as food orders lag and the lockup end looms. We have details, plus what's going on for its biggest investor, SoftBank, which is poised to post earnings. Plus, choose your spin. Peloton beats estimates on Tuesday, but analysts question the company's path to profitability. CEO John Foley says it is all part of the plan. He's telling Wall Street to look for the long game. And many state and local elections are taking place on Tuesday. In our electioneering series, we examine free speech versus falsehoods when it comes to political ads. To ban or allow, it is pitting Facebook against Twitter. But first, to our top story. So Uber, it tanked on Tuesday after failing to prove itself to Wall Street. While the ride-hailing app is projecting profitability by 2021, it just didn't seem to be enough. Shares are hitting a record intraday loss after reporting a rocky quarter on Monday. For more, I want to bring in Rohit Kulkarni. He's an MKM Partners Executive Director. Rohit, walk me through the share price action on Tuesday. What's your take?
Hey, Taylor, thank you for having me. And yes, I think what Uber did was ahead of its pre-IPO lockups expiry, they should have reported a very stellar quarter. But they reported a mixed quarter. They whiffed on gross bookings, but they had higher take rates, which led to a beat on revenue and bottom line. So it was a mixed quarter, and ahead of lockups, investors are not willing to stick around for a longer time, given tomorrow more than an estimated 800 million shares would be available for sale. Again, I'm taking a haircut of how many shares are not in the money in the options as such.
Okay, so Rohit, bear with me because I know you're on the phone, but I want to show a chart to our Bloomberg terminal audience here, which is showing the market cap of the company versus the value of that free float. And right now, it only looks like there's about $5.5 billion of free float outstanding. How much of the price action today seems to be a technical issue around the lockup ending versus the fundamentals that you were also highlighting?
It's both. I would add a third factor, actually, Taylor. The third factor is regulatory overhang. There are issues the company is facing in San Francisco, in London, and in New York. So there are three issues that the company is facing: technical, somewhat mixed fundamentals, and what's happening with the regulatory environment. So and near term, there are going to be more shares coming down the pike, which I agree with few investors who are bailing out on the stock today.
Do you think there's so much pressure on these recent companies that are IPOing to be profitable that no matter what they say will be adjusted EBITDA positive by 2021? Nothing is good enough right now?
I think there is a factor of how much you are going to believe in the story. Most of these names were story stocks. They have been great stories, and at some point, investor patience runs out. That instead of the story, we want to see execution. We want to see real numbers and a clear pathway towards profitability. I think Uber is taking steps, but I think they are just baby steps right now. We see the company getting to profitability. We see some numbers trending in the right direction, but again, it's fairly slow. So that's what worries the investors right now.
Well, and wrapping up Uber earnings for us, that is Rohit, and he will stay with me because I also want to pivot now to another company that was out with earnings today, and that is Peloton. The company is forecasting strong revenue growth, and they reported a narrower loss than expected for the quarter. Earlier, we caught up with CEO John Foley and asked about the report.
Our core bike business is profitable. It will be profitable over the next couple of years in the UK and Canada, and our our tread business is subscale from a manufacturing perspective, so it has lower margins. But as it gets to scale, the margins and the unit economics in that business go up as we get the cost of goods sold down through manufacturing scale. So we don't need to launch more products or more platforms or more geographies to that point to get to profitability. We may choose to invest in those things over time, but it's not something needed for profitability.
Do you have to lower prices, or we've got free trials being offered? How fierce is competition, and how hard is it to ensure that you win the scale in these new markets such as Germany?
Yeah, for better or worse, right now we don't feel like we have a true competitor, a like-minded competitor, as it were, a tech-based, well-capitalized company. So it's always been a question of should you lower the price on the Peloton bike. I founded the company with my co-founders 7.5 years ago. It's been incredibly academic to think about lowering the price. When you're doubling the company in size every year, including last quarter that we announced this morning, 103% top line growth, it's somewhat academic to think about lowering the price when you're making them or when you're selling them as fast as you can make them at the current price point, right? So we feel pretty good. The value that our members see when they buy one, and they can buy one for $58 a month, and then you would divide it by 2 because your live-in partner also rides. So that's $29 a month for the hardware, and then the $39 a month for the subscription. But for a household, that's less than $50 per adult for unlimited, fantastic boutique fitness classes at the best location with the best bike, with the best software and the best instructors in the world. It's a pretty good value proposition at the current price point.
That was Peloton CEO John Foley speaking to Bloomberg's Caroline Hyde and Romaine Bostick. And Rohit, you are staying with me. Give me your thoughts again on the share price reaction. You have a stock that today is off now almost 8% despite decent fundamentals from the company. What do you make of it?
Yes, I think, I agree. As in the company did report a very impressive quarter. Objectively speaking, as in the numbers tell a very good story. As in the company is growing revenues 100% year on year, 5 quarters in a row. The company is having stable gross margins with rising gross margins on the subscription side of things. So things are trending in the right direction. The company is pedaling in the right direction. Make no mistake. But I think today, given the investor sentiment, investors, as we talked about Uber, investors want to see a pathway towards profitability. And I think the story here, what Peloton is telling the investors is that, look, we are going to invest heavily this year, bear with us for this year, and next year we are going to show a real progression along the pathway towards profitability. I think it's just about patience. It's just about how patient investors are willing to be and willing to accept the story today. On top of that, you are selling a very, very expensive product. We don't know how large of the addressable market is. And a year goes by, and if we are in a macroeconomic slowdown, then what happens to the pathway to profitability? That's the worry that investors have today, and hence they aren't willing to stick around with the patience that John is asking them to have.
And are you sticking around with that? Because the CEO did come out and say, look, we could be profitable tomorrow if we wanted to. We just don't think that that's the right decision, that we really do want to invest in growth at this point. Are you comfortable knowing that?
As in, over the longer term, I feel we would be comfortable. But today, what I think, given the investor sentiment, given heavy losses, given that the company just acquired a manufacturer based in Taiwan, they are overburdening their cost structure. They are investing in marketing, investing in a lot of things, and we feel we will wait on the sideline until there is a clear step towards the company generating some cash flow as a whole.
Rohit, does it comfort you knowing that the CEO said that they don't really have a lot of competition at this point?
I would take the other side of that, Taylor. I think from a competitive standpoint, yes, there is nothing like a Peloton bike on the market with the integrated ecosystem and the content and the big screens and the various different bells and whistles. But when you look at consumers looking to see where can I work out today, where am I willing to spend $100 to $150 a month, and what can I do? There are a lot of options. There are a lot of health clubs. There are a lot of fast-growing boutiques. And also there are a lot of at-home connected fitness products, be it Nautilus, be it Mirror, Tonal. So I think if you take a broader view of options that consumers have, I think it's getting more and more saturated. And history says that at-home fitness, we haven't seen a very long-term trajectory of that yet. Maybe Peloton is the one that is going to show that pathway, but history says we haven't seen that yet.
Rohit Kulkarni of MKM Partners, he's the executive director. Thank you for joining us. And coming up, it is all about lessons learned. We hear from the CEO of Goldman Sachs, David Solomon, on what he's doing differently following some stinging losses from WeWork and Uber. That's next. And as we go to break, Match shares are plummeting in after-hours trading on Tuesday after the company reported a disappointing revenue forecast. The company is citing mounting legal costs and economic conditions like Brexit as part of its sales problem. Match's CFO, Gary Swindler, is saying that the company is embroiled in 2 or 3 big lawsuits. Last month, Match was sued by the Federal Trade Commission for allegedly deceiving consumers. Again, shares down are more than 15% in after-hours trading. Much more next. This is Bloomberg. Goldman Sachs was stung by losses in both Uber and WeWork, but CEO David Solomon has a message for investors in growth stocks. Profit does matter. Solomon spoke exclusively with Bloomberg's Matt Miller on the current state of the IPO market, including what could be the world's largest ever IPO, that is Saudi Arabia's Aramco.
We are involved in the Aramco IPO, but I'm not going to comment on something that's an active transaction like that. We've been in the IPO business for a long time. We've had a leading role in the IPO business, broadly all over the world for the last 30, 40 years. And so, generally speaking, when there's significant transactions, we're fortunate to be in a position to help our clients.
But it seems difficult to value this one. It seems difficult to value IPOs in general. There was a time when people were talking about WeWork as a $60, $65 billion company, and it's clearly not. Why is it so hard to put a value on companies this close to going private?
At the end of the day, where the rubber meets the road is what are investors willing to pay for a company when they have the transparency of the real financial information that's been vetted and presented in an appropriate way. And when you have that, the market will speak. And so, using WeWork as an example, there was a lot of hype around that, but ultimately, when investors were able to have a discussion with real financial information and provide feedback and work with an underwriting group to work with a company, there was a pretty clear view as to where the company could go public.
Can I ask you about this group of companies, the unicorns that have had IPO problems or have not performed well post-IPO, like Uber? Are you concerned that we're seeing reflections of the .com era where it was all about churning higher revenues and nobody really focused on making any money?
Well, I wouldn't compare it. These are real companies. We can debate the valuations, but they're certainly real companies, and I think that's very, very different than that narrow slice of time, during the .com bubble, where I think there were a lot of companies that were really in a different state that were getting to public markets. But I do think what's happening is the monetary policy that's been rampant around the world has basically forced people out on the risk curve, has forced people to look for other ways to drive returns. And one of the things they've been chasing is growth, and to some degree, growth at all cost. So I think there's been a sentiment that if you can hook your wagon to a company that's got a lot of growth and is focused on growth, that something good, will come to that. That has incented lots of companies to take the capital they're raising from investors and spend it very aggressively to drive top-line growth without really understanding the consequence of how that can translate to profitability. And I think the market here is kind of speaking and telling people, you know what, let's rein that in a little bit. It's important for people to grow, but there's got to be a clear and articulated path to profitability, to earnings in some way, shape, or form. I'm a big believer that over time, a company can only be worth, over time, the discounted future value of its earnings. And so it's important that you have a business model ultimately that can generate profitability, and I think there's a little bit more market discipline coming into play, and I think that's healthy for markets.
That was Goldman Sachs CEO David Solomon speaking to Bloomberg's Matt Miller. And for more, let's bring in Bloomberg's Sonali Bosick in New York. Sonali, in all of your years covering the banks and the CEOs, have you ever heard them talk so much about that responsible growth, about the market now starting to really discern between that path to profitability?
I think that the markets have been really irrational for a number of years now, just like David Solomon had just said, because of central banking policy. But as we get into the next leg of the central banking policy, frankly, this lower for longer type irrational behavior that's driving these sky-high valuations has to come to a reckoning, because guess what? Everyone's not Amazon. And so now finally people are starting to tighten the reins. It only took one major flop for people to turn around quickly on that one. We've had the head of investment banking at Citigroup early September tell us that for Bloomberg Television as well. People were already starting to tighten the reins late this summer. And so that talk is getting a lot louder, certainly for banks like Goldman Sachs and JP Morgan that stuck with a lot of these companies through very tough times these last couple months.
And talk to me more about Jamie Dimon's comments from JP Morgan about this, where he really said private markets, those aren't real valuations because you don't have a price discovery. You just have an investor telling you this is what it's worth. What are your thoughts?
So not only that, Jamie Dimon is saying something very similar to what David Solomon is saying here, which is that one investor doesn't set a valuation, right? A market of investors sets a valuation. And so things can be pretty volatile and fickle until then. Jamie Dimon also said something that SoftBank is also addressing, which is changes in corporate governance. That's something we've been waiting for forever here in this hot market. And so SoftBank right now, according to the Financial Times, is thinking about tightening the reins in terms of corporate governance for the companies that it backs. And that's something you heard Jamie Dimon also address.
You know, Sonali, another story that all caught our attention here as we take a look at the tech landscape has been Robinhood Markets, which said, and there was a story coming out that basically put down a little bit of a deposit on margin and then you get infinite leverage. There's a glitch in the system. What is it?
So basically what's happening here is you have a certain set of Robinhood users who are selling calls, and that money is then being counted in that the user's capital. And so this is such a timely story, right? We're a week away from Money 2020 here. Thousands of people were meeting about the future of fintech. Once you're borrowing from a firm, you're becoming a bank and a personal hedge fund, right? So you're sitting here and you're having to deal with issues as you scale and grow. And Robinhood, as we know, is trying to not only grow, but has considered a banking charter as well. And so these glitches never look good in between, but they do say that it's isolated to a certain number of users. With that said, the users that have been doing this say that they've levered maybe a $4,000 investment into $1 million investment. And so they're pretty insane trades that we're seeing here that a lot of people are bragging about being able to take advantage of this glitch.
Well, Sonali and I are going back to derivative school to learn about covered calls and margins. That was Sonali Bosick. Thank you for joining. And coming up, it is more from Bloomberg's extensive Tesla Model 3 survey. We dive into how many owners feel safer with the Autopilot feature. That is next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. And be sure to follow our global breaking news network at TikTok, on Twitter. This is Bloomberg. It is the biggest survey of Tesla drivers ever conducted, and Bloomberg has polled almost 5,000 Model 3 owners and asked about Tesla's software for automated driving on highways and parking lots. It turns out more than 90% said that the feature made them feel safer. Bloomberg's Craig Trudell, who covers Tesla, joins us now. So Craig, Autopilot, helpful or hurtful?
It's a messy answer to that question. Such a simple question, but such a complicated answer, as is so often the case with all things Autopilot. This is a system that Tesla has generated so much buzz with, that Elon Musk has invested so much money in and sort of reputation in. And the findings of this survey are fascinating. There are sort of data points galore in here, as you would expect with a survey as big as this was of of 5,000 drivers. You have a lot of people who claim that Autopilot, some even that actually go so far as to credit the system with saving their lives. There were 9 people who said that. But 6 within the survey also claimed that Autopilot contributed to a collision. You have more than 90% of people that say that they feel like this system makes them safer. But I'll tell you that it's sort of a running joke covering the car industry that 70, 80, 90% of us think that we're above average drivers. So it's hard to sort of put too much stock into that claim. But what we do know is that this sort of messiness of the findings of this survey reflects the messiness of the future of automated driving, in that there are going to be times that these systems save us, and there are going to be times that as these companies are ironing the kinks out, that they put us into dangerous situations.
So Craig, describe for me, as I try to spit my words out, describe for me the distinction between autopilot, and I can take a nap in the back seat, versus auto assisted, where I should maybe be paying attention and not just snoozing in the back. Where are we in that technology?
Well, we shouldn't be in the position of napping in the back seat, even with autopilot, and that's why this system is so controversial. That name has this sort of connotation that you could do that, and we've seen these videos that people take on the highway where they see someone actually who's fallen asleep at the wheel of their Tesla and relied on autopilot to continue to drive them even though they haven't paid attention. We are not at the point yet where you can safely do that, and that's why it's so important that Tesla does emphasize that people should be paying attention at all times. But you do also get these mixed messages from Tesla where, when Elon Musk is sort of touting this system to CBS last year, he's showing the system around with his hands on his lap. That sort of goes against what's actually in the handbook when you buy a Tesla, how you should be using this system. This is a company that talks about a full self-driving package with Tesla, and yet this is not a system that can safely be relied on for self-driving in any sort of situations fully. This is a system where you need to be paying attention, and it's why this is technology that's been so controversial.
And Craig, quickly here, describe the 2 different packages that Tesla offers within Autopilot. There's been software updates, and there's different packages that you can or can turn off. What are those? Yeah, so what they do is they sell a higher level of capability, and some of that capability they haven't delivered yet, and it's unclear how long it will be delivered. But with that subsystem of full self-driving, one of the sort of features within that suite of technology, for instance, it is a feature that allows you to call your car to you in a parking lot called Summon. And just with that, we've seen sort of near misses that have grabbed headlines. You do see people that are very excited about it and like to show it off, but it's again, come back to the word controversial. Bloomberg's Craig Trudell, not controversial. Thank you for joining us. And coming up, Bloomberg Technology, our global link. It is our conversation with the FCC chairman, what he has to say about Huawei being caught in the trade war crosshairs. That's next. This is Bloomberg. This is Bloomberg Technology Global Link, where we now join Bloomberg Daybreak Australia to bring you the latest in global tech news. I'm Taylor Riggs in San Francisco, in for Emily Chang, and with Sherry Ann in New York and Heidi Stroud-Watts in Sydney. Let's take a look at those global tech stories of the day. Heidi.
Taylor, Masayoshi Son is paying the price for his bold bets on startups from WeWork to Uber. The SoftBank founder has seen his net worth slide $6 billion from its peak this year after his strategy of aggressively backing technology pioneers backfired. His fortune tumbled to roughly $13.8 billion as of Tuesday, after peaking in July at about $20 billion. That's according to the Bloomberg Billionaires Index. Facebook has expanded its production to Vietnam and will manufacture its Oculus Rift XS virtual reality gaming headsets in the country. That's according to the Facebook Asia Pacific Vice President of Public Policy, Simon Miller. Facebook is seeking partners to manufacture other products in Vietnam. And Huawei expects smartphone shipments to grow 20% next year, even if it's blocked from the latest Google software. This suggests the Trump administration's efforts to contain the company's rise may not be working. Huawei's president of corporate strategy says the company can rely on its massive home market and in-house software to keep the division humming. And those are your top global tech stories of the day. Sherry.
Heidi, thank you. More on Huawei as the U.S. trade with China plunged in September following fresh tariffs. Now, both countries are aiming to ease tensions, with U.S. Commerce Secretary Wilbur Ross saying that licenses to sell to Huawei will be coming, quote, very shortly. Earlier today, I sat down with FCC Chairman Ajit Pai, who warned that Chinese tech firms pose a threat to U.S. national security. Take a listen.
We've seen a great variety of evidence with respect to particular Chinese vendors behaving in ways that are not consistent with the rule of law, with free markets and the like. For example, earlier this year, the Department of Justice announced an indictment against Huawei, in which case the indictment specifically states that Huawei officials offered bonuses to individuals who successfully stole confidential information from certain businesses. And more generally speaking, this is part of the overall Chinese government effort, we fear, to leverage their influence over global commerce.
No wonder the FCC has a vote coming up November 19 to prohibit companies receiving federal subsidies from buying equipment from Huawei and ZTE, right? Will this banning of firms selling to Huawei or carriers not being allowed to use cheaper Chinese equipment have an impact on these U.S. firms and jobs?
Well, I start from a bedrock principle. When it comes to the security of America's communications networks, we can't take a risk and hope for the best. We need to get it right, especially with something as transformative as 5G. And that's why when we've rolled out our proposal, we've made very clear that we don't want federal funds coming from the FCC to be spent on untrusted vendors, wherever they might be located or whoever they might be. In this particular case, we have serious concerns that China's national intelligence law requires companies like Huawei to comply with requests from intelligence services and not to disclose that to any of their customers.
To be fair, Beijing argues that 2017 national intelligence law that you're alluding to is actually defensive. It doesn't authorize preemptive spying. Why aren't you convinced?
In part because the Chinese government has made clear they want to leverage their influence in any particular area, and especially when it comes to telecom networks, that is a risk we simply cannot take. Secondly, we've seen evidence, I mentioned the indictment involving T-Mobile earlier this year, that vendor in particular has engaged in certain practices that we find problematic. And here again, we want to make sure that the equipment and services going to America's communications networks are secure. That is the base level expectation that every American regulator, every American consumer should have.
But these small and rural carriers have bought Chinese equipment because they're cheaper, right? So if you tell them that you have to remove them and replace them, what would be the financial cost for them, and would you help them out?
Two different points. The only problem with cheap is that sometimes it can cost too much, and especially when we're talking about national security, that is a risk we don't want to take. But secondly, later on this month, the FCC will be voting on my plan to evaluate what equipment from Chinese vendors is in our networks and to think about ways to fund the replacement of it. And so that's a conversation we're going to be kickstarting in a couple of weeks because we recognize the concern that has been raised.
Where would the money come from? Would that come from also the Universal Service Fund?
Congress is currently considering legislation to fund the removal and replacement of that equipment.
Would that happen before they actually go through the process? Because some of these small carriers don't actually have the credit to go ahead and do it and then get it refunded.
That's one of the things that we're going to be exploring in this conversation about how to make that transition from the current state of the network to the more trusted vendor framework that we'd like them to operate under.
The reason that we're focusing so much on security these days is because of the launch of 5G, right? Okay, yeah. So two companies that have said that they will try to deploy flawlessly this 5G has been T-Mobile and Sprint. Yeah. You have cleared them for their merger. Do you expect the FCC order to have an impact on those bunch of states that are actually suing that they don't want to see this happen?
Well, certainly I would hope that those states would recognize what the FCC has recognized, what many people have recognized, that the consummation of this transaction would be in the public interest. One of the commitments I got from the companies and that the companies agreed to was to deploy 5G to 99% of the American population within 6 years. 50 megabit per second service or greater to 99% of Americans. That's a huge public interest benefit, more in-home fixed broadband competition, price commitment. These are the kinds of things that are going to be consistent with the public interest.
The argument, though, is that would have happened anyways because T-Mobile and Sprint had committed to the deployment of 5G anyways.
That's not the case when you look at the spectrum assets alone. For example, T-Mobile has a very good position in low-band spectrum and high-band spectrum, but it doesn't have mid-band spectrum assets. Sprint has good mid-band spectrum assets, but not necessarily strong low or high-band assets. For 5G, you need a mix of all three, low, mid, and high. And we think that that newly capitalized company, once it's together, will be a greater competitor. And especially when you're talking about an industry where, by some estimates, the two largest competitors have 93% of the free cash flow, we want to turbocharge a third competitor to compete with them. And we believe this transaction will do that.
When would this happen? It's been 18 months. When do you expect it to happen when even that hearing by the state's lawsuit hasn't happened?
I can't forecast what litigation is going to, how the litigation is going to turn out. That, of course, depends on the state AG lawsuit here in New York. From our perspective, at least, we want to make sure that the public is able to benefit from some of these commitments we've gotten from the parties that will deliver faster, better internet access services when it comes to wireless well into the future.
That was FCC Chairman Ajit Pai. And now, Sherry, it's so interesting because you spoke with him about some other news, particularly Twitter's decision to ban political ads and taking a firm stance against Facebook. What was his take on that?
Yeah, the reason that I asked him that was because Ajit Pai has been really vocal about free speech, about transparency, among these big tech companies. So I asked him, what do you think about these bans on political ads by Twitter and Facebook not doing so? He's saying, you know what, we don't regulate content companies, so he doesn't want to talk about that. But he's saying that it's very important to have transparency, that you want to know how these companies are making those decisions. So he was very vocal on emphasizing privacy concerns, transparency, something that he actually talked about already in a blog post last year. I asked him, what did you think of progress made since then? He's saying those are coming in fits and starts around D.C., but at least that the conversation is going there, Taylor.
Well, thank you to Bloomberg's Sherry Ann for that great interview and Heidi Stroud-Watts. Much more to come next. This is Bloomberg. It is the social media battle line being drawn ahead of the 2020 U.S. presidential election. In one corner, it is Facebook and CEO Mark Zuckerberg. Their message to politicians: the social network will not police the accuracy of your ads' content. In the other corner, it is Twitter and CEO Jack Dorsey with the total opposite stance: no political ads at all on Twitter. Now, this all comes at a time when Cantor predicts online political ad spending will total $1.2 billion out of the $6 billion spent in 2020. And who better to discuss this in our electioneering series leading up to the 2020 elections than two people who intimately are familiar with how politicians leverage social media. In D.C., we're joined by Jason Rosenbaum. He's president of Seward Square Strategies. Before that, he was Hillary Clinton's digital ad director and a member of Google's political ads team. And then I have Tim Cameron. He is CEO of FlexPoint Media. Prior to that, the chief digital officer for the National Republican Senatorial Committee. So I'm going to start with you both here, ask the same question. Tim, I'll start with you. Your take on Facebook versus Twitter. Who's right?
Well, I think Facebook's right here, and largely the reason why Twitter decided to get out of political ads isn't a moral one, it's a financial one. They only made $3 million last election cycle, which is basically a rounding error of all the online ad revenue that there is in politics. And this is an embarrassingly low number for a company that is arguably the most political social network in the world.
Jason, your thoughts?
Well, I think both companies' approaches are actually problematic. What we're seeing here is sort of an abdication of their responsibility. And this is an issue that we've dealt with other forms of media for decades. And what we're lacking is a legislative and regulatory approach to provide some guardrails for social media paid advertising. Local TV and radio stations for years have been prohibited from running factually incorrect advertising, and political advertising should be no different. And so what we need is for Congress and regulatory agencies to implement some kind of guardrails for this technology. The obvious first step here would be to pass the Honest Ads Act, which would provide true disclosure for political advertising so we know who is spending what and where.
Tim, I want to take a step back and take a look at Facebook in particular, who has taken a stance on this. Part of their ads are really hyper-targeted. And when you talk about this, we want to distinguish, how do you make sure that within those hyper-targeted ads that they are accurate? How do you go about doing that? Should we not do hyper-targeted ads? Should we?
Look, I don't think hyper-targeted ads are necessarily any more risky than broadly targeted ads. You can disseminate false information to a small group or a large group, but this is the cost that we pay for living in a free society. To quote Supreme Court Justice, or former Supreme Court Justice Anthony Kennedy, the remedy for false statements is the truth. And that's just the cost of living in a free society. To protect the First Amendment and to be able to get out there without prior restraint is something that's important, because if we start prohibiting ads, and you look at, say, somebody like Elizabeth Warren, who's completely in favor of Facebook taking on this role, despite saying at the same time that they're way too powerful, you risk, potentially Republicans from being blocked from saying that her plan on Medicare for all will raise taxes on the middle class. And, maybe not this election, but down the road, that could lead to tyranny.
Jason, in your earlier comments, you brought up some of the local media coverage or radio where they're not allowed to run false ads. I wonder if part of the problem here is the ads on Facebook or some other sites aren't clearly marked as ads. Do we need to do a better job of presenting these ads for what they are, paid for by or list, and make it very clear that these are ads? Would that help solve part of the problem?
Well, we do have that. So federal election law requires that paid political advertising be disclosed, that there's a disclosure on those advertisements. And we should have that. But we should also have checks in place to ensure that political candidates, political organizations can't run factually incorrect advertising, knowingly do so. These are checks we've had in place for over 50 years for broadcast television and terrestrial radio. And we have a new technology with social media that's still in its infancy, and it's proven to be remarkably powerful in its ability to change people's opinions. And so we have to ask ourselves, are we going to provide some guardrails here? And if we are, and I believe that we should, are they meaningful? And I don't believe either banning political advertising or throwing our hands in the air and saying candidates can run whatever they want is meaningful reform.
Tim, in response to some of those comments that Jason was making, I also wanted to bring up a quote from Trump's campaign manager talking about the 2016 and the election and the role that Facebook played in that, where he said, I think Facebook is how we won in a lot of ways. I think President Trump won. I think Facebook is the 0.01% that delivered that message. If Facebook didn't exist, it would have been a lot tougher. Your take?
Look, I think that's absolutely true. I think it's a big reason why they won, and I think it's a big reason why a lot of campaigns have won. It's not the singular reason, but definitely a contributed one. But everybody's looking at this from the perspective of the presidential campaign, and the implications go much further down. In fact, a lot of what these social networks do is enable city councilmen and state house reps and smaller candidates to gain traction. And, what's so ill-fated about the move that Twitter pulled by banning political advertisements is that it's going to have a distinct impact on smaller, under-the-radar candidates like, say, Andrew Yang, who, suffered underneath a media blackout for months, and prevent them from getting their message out. And so we really have to think through what the long-term implications are here, because this is bigger than the 2020 election. We're talking about the First Amendment, which is something that is just fundamental to our society and hopefully will be here for centuries to come.
Jason, finally here, as you sort of take a look out at the landscape and the Democratic committee, where are they in catching up with online spending? We remember Barack Obama was very tech savvy. He came out and was really able to get that niche younger audience, in part because of technology and social media. Where is the Democratic National Party on this today? Have they done enough?
Well, we have a crowded Democratic primary field, and most of those candidates are running, I think, very aggressive, sophisticated programs. It's been probably written a lot that President Trump is spending significant amounts of money online. He's the incumbent, and he has a large war chest right now. The Democratic candidates are spending significantly in early states and across the country, and I think I believe still far more sophisticated than many of the Republican candidates in the field.
You know, Tim, earlier in the conversation, Jason had said that some of this solution to all of this could be more regulation. I just want to give you a chance to comment on if regulation looks like the right answer in your opinion.
Look, I'm always hesitant to adopt regulation around speech. If you look at a common thread between totalitarian governments, it's that they have a ministry of truth, a ministry of information. Do we need to implement that here, and do we need to have government regulating speech? Look, false advertising and fake claims made by political candidates isn't a new phenomenon. It's been something that is dated back to ancient Rome and ancient Greece and to the very origins of democracy. We're a society that knows how to handle this, and I don't think a regulatory framework is necessarily something that we need added on here. And there are a number of remedies, such as libel, slander laws, and so forth, as well as the Fourth Estate that the media controls to combat these fake ads.
Jason Rosenbaum of Seward Square Strategies and Tim Cameron there of Flex Point Media, thank you both for joining. And it's still ahead. It is tech investments taking a tumble. Could this be a tough quarter for one of the world's biggest investors in startups and tech companies? That's next. This is Bloomberg. Investor giant SoftBank will be under scrutiny when it releases earnings on Wednesday. Now, sources say the company's vision fund is planning to swallow a write-down of at least $5 billion. That is reflecting a plunge in the value of some of its biggest holdings. The company's founder and CEO, Masayoshi Son, will give details of that damage during the earnings call, and it's expected to include a major loss of the failed attempt to take WeWork public. Joining us to break down the earnings numbers, it is Bloomberg's Ed Ludlow. Ed, what are analysts expecting?
A big loss in the quarter, Taylor. Our average analyst estimate is for a net loss of 300 billion yen, or in other words, $2.7 billion US dollars. Compare that with the same quarter a year ago. SoftBank registered a profit of more than 500 billion yen, roughly $4.5 billion. And as you said, the company is expected to book a significant write-down on some of its biggest investments. Of course, WeWork has taken the headlines with the money that SoftBank has put into WeWork in its failed attempt to take the company public. But look at some of the publicly traded companies in the Vision Fund portfolio, because they've also underperformed. Names that had been shining stars for SoftBank. Come with me into my Bloomberg. This chart shows shares of Uber, Slack, and Guardant Health. You can see Uber, the white line, and Slack, the blue line, have really seen major declines, more than 30% in the quarter ending September 30th. Of course, SoftBank has big stakes in those companies. Another company that SoftBank has a big stake in is the wireless carrier Sprint, 3.5 billion shares, or 84% of the company, on the cusp of being purchased by T-Mobile. That deal was given a green light by regulators, the Federal Communications Commission. Some good news for SoftBank, which has a lot riding on this deal, but they're not out of the woods yet, Taylor, because US states have brought a challenge on that deal in the courts on antitrust grounds. The trial is due to start in December. So we want to hear about both of those things on Wednesday from Masayoshi Son about the underperforming investments and that deal between Sprint and T-Mobile. Taylor.
Thank you to Bloomberg's Ed Ludlow. And for more now on SoftBank Vision Fund and the venture capital landscape, I am joined by Mark Hannes. Mark is a professor of entrepreneurship and innovation at the University of San Francisco School of Management. Mark, as we just take a look at SoftBank here, how much of a permanent or temporary scar would be the big write-downs for both SoftBank and their Vision Fund this quarter?
Well, you really have to, well, first of all, thanks for having me, Taylor. I think for any venture fund, which is really what the SoftBank Vision Fund is, you really have to consider that it's a long-term fund. And so, like any venture fund, you don't necessarily expect every investment to do well right away, or sometimes ever. So while certainly in the short run, the write-down is going to hurt, definitely. However, the time span for these types of investments is much longer than, say, for a typical public portfolio. Or rather, it's really measured in years rather than days or months.
Well, and Mark, like you point out, the whole point of venture, that word alone means venturing out, taking risk. Are we scrutinizing those companies too much? And should we assume, yes, some are bound to fail?
Well, certainly as a venture, a typical venture fund, which is typically, again, much smaller than the SoftBank Vision Fund by a factor of 100 or more, there is an expectation that many of these companies a portion of the companies will fail. The different thing, again, about the Vision Fund is that it's so large and the investments are so huge that failure is magnified. And of course, so we have more interest in those because we're talking about much, much larger numbers.
Mark, in your decades of experience, have you recently, let's say in the past year or so, really started to see a differentiator between the venture capitals that are succeeding and frankly those that have been failing, publicly in the IPO markets?
I see. Well, that's a great question. Thanks. I think typically the major venture capital criteria really starts and ends, for the most part, with the management team. So just like as I understand, Masayoshi-san, interviews every entrepreneur before he invests the Vision funds into the company. So too, all venture capitalists take a very, very hard look at the capability, the sincerity, the passion, the integrity of the management team, and really, it's this type of criteria, along with, of course, a huge potential market that over time leads to more successful firms. Because business models may change, markets may change, but the management team and its determination to make something work is often the deciding factor.
We will have to leave it there. Thank you to Mark Canis. He's a professor of entrepreneurship and innovation at the University of San Francisco School of Management. And that does it for this edition of Bloomberg Technology. Tune in tomorrow. This is Bloomberg.